Welcome back to Business Incorporated here in Channels Television now. Talking about those currencies here in Africa, Ethiopia has ordered banks to deny foreign currency to businesses importing non-priority goods in an effort to shore up dwindling foreign reserves in the country. The move effectively freezes the imports of dozens of items such as alcohol and cars, as businesses must register with banks to obtain the foreign currency needed to bring goods into the country. Let's find out what impacts this will have in the face of course, the global headwinds we've been talking about. We have Matt Kindiga joining us now. Hi, Matt. Good afternoon. Good to have you, even though it doesn't look so good for a lot of African currencies at this time, Matt. So when we see these efforts by Ethiopian government, I mean, this sounds like what we're already doing here in Nigeria. What impact can we expect from this?
Hi, great. Well, thanks for having me on the show today. Yes, certainly we are seeing quite severe foreign currency stress across sub-Saharan Africa, including in Ethiopia, as you've mentioned, Nigeria as well, some depreciation as well as foreign currency shortages. In terms of the impact of foreign currency shortages, well, we're finding multinationals are really struggling to access foreign currency, domestic companies as well struggling to access foreign currency. But in terms of why the central bank is doing this at the moment, so foreign currency shortages in Ethiopia have been a problem for a long time, but they've really worsened as a result of two factors. One is the domestic civil war, and the other is the Ukraine conflict. We've seen investor sentiment dry up very significantly in Ethiopia as a result of the civil conflict. And we've also seen the country's terms of trade, the trade balance, deteriorate as well, as the cost of commodities globally has skyrocketed, really. So the cost of imports has increased very significantly, and the government is trying to, and the central bank is trying to prevent a run on the beer or a significant depreciation of the currency over the next couple of months. It also wants to avoid the sort of inflationary spike that we're seeing at the moment. So certainly the government is under a lot of pressure to preserve its foreign currency reserves. One of the other factors, though, which is very important in our view, is that the central bank is probably trying to preserve or prioritize foreign currency access for the armed forces, because as we know, the government's civil war in the north of the country is very protracted. It's been going on for a very long time, and the government is struggling to emerge victorious. So certainly we do expect this is a reason why there are severe foreign currency shortages there.
Yeah, but I guess we can hardly have this conversation without talking about the civil war there, you know, and the outlook and the role it plays in all of this.
Yes, that's right. I mean, the civil war is, well, an end to the civil war is a prerequisite for improving access to foreign currency, improving foreign currency availability in general. Our view for the civil war is that it is very uncertain, although there are maybe increasing signs that both sides, so the central government and the TPLF, the Tigrayan People's Liberation Front, are increasingly enthusiastic about coming to some kind of deal. Our view is that we're probably going to see a cycle of fighting interspersed by truces that are broken quite easily, so fragile truces, probably for the next 3 to 6, maybe 12 months. Although both sides want to come to a deal, they're so far apart in terms of their negotiating positions and their ability to reach a sort of a meaningful settlement that we don't think a long-lasting peace deal is going to happen very shortly. So we would expect the status quo to continue. This does mean that we expect economic reform and investor sentiment in the market to remain relatively muted for the foreseeable future. So we don't really expect any significant change to the way that the civil war pans out over the next few months at least.
So with this outlook, how are businesses approaching Ethiopia?
Yeah, so the combination of the civil conflict and the foreign currency shortages made a lot worse, which will be made worse by this recent change in legislation to ban non-essential imports or access to foreign currency for non-essential imports does mean that companies are taking a more cautious approach, especially foreign companies, towards Ethiopia. It's a really interesting change in attitudes that we've seen. So about 2 or 3 years ago, most of our multinational clients that we advise were very enthusiastic about Ethiopia. They were ramping up their investments. They had very ambitious growth plans. But what we've seen over the last 12 to 18 months is that most companies are either putting their investment plans on hold or they're shelving them altogether. I would make it very clear, though, that very few companies are divesting. And this is because Ethiopia remains it is still growing, and it is a large and quite attractive economy for many companies. Also, companies operating in Addis Ababa are not directly affected by the civil conflict, and that is where the majority of economic activity takes place. But in order for businesses to view Ethiopia much more favorably and to restart their investments, we would need to see a permanent end to the civil conflict and also a significant improvement in access to foreign currency over the longer term. So a couple of things need to change before businesses become a bit more enthusiastic about investing in Ethiopia.
Yeah, we look forward to those changes that are necessary, Matt. Thank you so much for sharing your perspective with us.
Thanks very much.